Hello, everyone, and welcome to our June 2026 podcast. My name is Carly Purcell. I am joined here today with my coworkers,
Ryan Chever,
Patrick Cummins.
You will notice that Derek Vince Olkma is not with us today. He is on vacation all week, so we hope he's having fun. You will see him on the next podcast.
Got to take those vacations in the Midwest while we got the good weather.
No.
It doesn't last for long.
Beautiful outside.
It's beautiful.
Long days, birds are chirping. We love it.
That's right.
So speaking of June, you mentioned June in your last client.
Yeah, video is kind of a hangover month. We could jump into the market update, I guess, on that. And when I say hangover month, what I mean is that it's not just somebody who's out consuming a bunch of adult beverages. I mean, maybe somebody stayed up too late. But what I'm getting to is fatigue. Fatigue. Markets suffer from fatigue from time to time. Think about the back-to-back moves that we've seen in the S&P 500 in the months of April and May. The market finally gave us a little bit of a breather. We saw the market, the S&P 500, generally speaking, that's kind of what we talk about as the market. Top 500 companies in the U.S. Actually pulled back almost 1%, 0.95%. We saw finally a down month, and that's okay. Markets deserve to kind of price discovery. When markets come down, you're testing the investors that bought into those moves higher. You're saying, well, did you really intend to hold this for the long term or not? And you can really tell what an investor's mindset is when times get a little bit tough, if you will. Are those hands nice and strong? S&P 500, again, had a negative month, down 0.95%. Bond market, though, actually gave us a positive return. And that's been good. So 0.24%, so not a tremendous move to the upside. We look at the bond market through the lens of the aggregate bond index. It's just a basket of bonds, diversified basket of bonds. So those of you aggressive investors with just a lot of time, you can take the extra volatility and stuff. You probably don't have bonds in your portfolio, but for those of you who are in retirement and taking a distribution, something like that, we need to find some stability through diversification. I'm not saying that bonds are the way to remove risk from your portfolio, but again, it's a depth of diversification. So we got a positive return in the aggregate bond index. That's been good. Kind of a mixed bag.
Mixed bag.
Yeah.
So more specifically, portfolio changes for clients.
We made some. And we talked about this last month, be prepared. Some things that we'll get into a little later in the podcast were kind of the catalyst or the impetus for some of these movements. Not tremendous moves, just setting the table for a different style of movement under a new Fed regime, under a market backdrop that has been running pretty darn good for the last few months. And sometimes the things that didn't necessarily move up at the same robust pace might be an opportunity for us. So just kind of rotating, and I'll tell you exactly what we're looking at here, is kind of a little bit of a tilt towards just growthy stocks. I mean, what is a growthy stock? Imagine if a company, remember when you buy a stock, you invest in a company. You're an owner of a company. Well, imagine if a company said, hey, all the money that we make, we're going to pour into research and development because we've got this tremendous technology that we're building out 10 years from now. You as an investor are going to see a return on that. What you're doing there is saying everything, it might even push a company where they're not making money, but it's all focused towards growth. That's one style of company. There's another style of company, and maybe we're talking about an industrial application where there's not a tremendous amount of research and development. So every dollar that would come into that company in revenue, maybe they're paying it out as a dividend. Or perhaps a company has a really, really clean balance sheet set up. They're going to tilt towards quality. So quality value really hasn't seen the robust movement higher that we've seen in that growth contingent. So not that we're abandoning growth by any means. I still think there's tremendous opportunity there, but we're setting the table for a little bit of a rotation, if you will. And some of that came from the words from our Fed chair, which we'll get to later. So finally got some movement in portfolios. I've gotten a few calls already, and Carly, you probably have too, with, hey, I got some transaction confirmation. So that's what's going on. And that doesn't mean that everybody's portfolio moved. That means that the portfolios that needed it got it. So,
correct.
Yeah, we're moving.
And that's a great part, right? To your point, a lot of the changes you just made adds diversification and more of it to our portfolio. What is having a diverse portfolio? Why is that important? How has that helped us over these past few months?
So you bring up a good point with respect to diversification. So diversification is combining assets that don't move in lockstep with each other. The idea behind it is in a day when one is down, the other one that doesn't move like that might be up. And so you can kind of smooth out your ride and your glide path there. And what Patrick is alluding to is we can be diversified in a number of different formats. The idea is to lean into the turns to give us an edge. So look for those opportunities, set the core foundation of the portfolio, be diversified in that respect, and then step on and go a little bit extra in the parts of the portfolio in the market, if you will, that would yield potential opportunity. So again, diversification is important. And we use it for stability, but we also use it for opportunity seeking because we will weight the places that we feel those opportunities are, and we'll lighten up on the places that we think that the threats are. So diversification is really important. And, take the Russell 2000, which is going to be, we always talk about the S&P 500, top 500 companies by size. Well, the Russell 2000 is going to capture 2,000 smaller companies here in the U.S. It was up 3.74% in the month of June. So just, not quite 4%, but that's a really good rip considering the S&P 500 was down almost 1%. So that's that rotation that you're seeing. That's a broadening of the market move higher, and we've talked about that. But again, are you there when that move happens? Are you diversified in that space? And so how about this? What if us lightening up on that growthier space was taking advantage of some of that outperformance and again, trying to rotate into an opportunity? So diversification does a number of different things, smooths out the ride and allows us to be tactical and strategic.
And that's great, right? One other main catalyst we saw in the month of June was actually the largest IPO in our history.
You got that right.
Talk to us a little bit about that and what that means for the market.
And we're talking with broad brushstrokes here because we don't want to talk about individual stock names. Just keeping compliance is good graces. But largest IPO in history. One of the things that you're seeing with companies these days is they wait longer and longer to become public companies. When you become a public company, you have to have certain disclosures, have certain things play out on your board of directors and stuff. When you're a private company, you have a lot more control over what's happening. Typically it's the founders that like to keep the people that start the companies, like to keep them private, and they're keeping them private for longer and longer. It's, the IPOs that we're seeing these days are bigger and bigger, and they're coming out in that initial public offering as large, well-established companies. So an IPO, initial public offering, that's the first time the public can gain exposure, ownership of a company. Well, imagine if you have the largest IPO in history and it's coming out as a mega cap company. It's a big company. And then you zoom out and you look at, well, wait a second. Large cap stocks actually suffered in the month of June. Medium and small caps did pretty darn good. Remember the Russell 2000? I wonder if people were selling large cap stocks to be prepared to buy a large cap stock that was not available prior. Markets have a lot of different reasons why they move. And that's why it's really important for us to focus on the long term, not day to day. I mean, we look at this month to month. It's fun. We like to reach out to you. But, you got to take a longer term perspective. And that largest IPO in history is a good way to illustrate that markets move sometimes for reasons other than fundamental, for reasons other than what you might think. So interesting to see. And I expect a few other big ones this year.
Yeah, that's a great point.
Yeah.
Right. And not only was that one of the largest things that happened in June, but we also saw another very large event occur. And that was Kevin Warsh, our new federal chairman, had his first press conference.
Yeah.
What are your thoughts and how did that go?
Well, and it kind of was, again, that listening to Kevin Warsh, new Fed chair, got installed in May, but June, this was the first interest rate decision that he led. Now, granted, he's just the president. There's a voting board, so it's not just his decision. The idea is that the Fed president communicates amongst the board members as they're making their decision and is kind of that quarterback, if you will. Kevin Warsh came out, the Fed did not, they left rates unchanged. But one of the things that we did hear in that press conference were hawkish tones. Hawkish tones means that theoretically they are focused on controlling interest rates by throttling back on the stimulus that the Fed pushes through the capital markets. That's what hawkish means. Hawkish, it's somebody who's really watching the amount of stimulus, because after all, stimulus does create inflation. You know, if you're just reading a textbook, all right, there's a lot that goes into that, but I mean, that's just the basic explanation. So hawkish is being very focused on maybe reining in some of that stimulus. Dovish, on the other hand, so a dovish Fed is where they're very liberal about stimulus. They're okay with accepting some inflation. We heard hawkish tones from Kevin Warsh, and in that environment, one of the things, if that's the direction he wants to go, you might see that rotation happen into a more quality type of company stock performing better than that. Like high growth stocks love a dovish Fed, traditionally speaking. So what we're seeing right now is maybe some hints of hawkishness. It's the first press conference. I don't know that I'd read too much into it, but it was nice to see that he's even doing the Fed press conferences, because that's not something that the Fed has to do, but it is a nice communicative mechanism to kind of tell investors where the Fed's head is at. So it was good to see.
Yeah.
And before we move on, I just want, when you look at the past Fed chairs, going back to really Ben Bernanke, Janet Yellen, Jerome Powell, they've all hailed from a similar school of thought. Kevin Warsh has a different school of thought, and that's why this is so interesting to me, just studying where he's going to take this thing. So we will stay dialed right in.
Yeah, it's very interesting, right? And really what they're trying to combat is inflation. And what we saw throughout June was inflation still hanging around for multiple reasons. Yeah. Where do you see that going and some of the catalysts of driving that?
Yeah, let's unpack some of those economic mile markers that we've got to pay attention to. The Fed has what's called a dual mandate: promote full employment and support price stability. Promote full employment means they want people working. So they want to see jobs. And then, that price stability is just a fancy way of saying inflation, control inflation. So there's their dual mandate. Ironically enough, sometimes that dual mandate flies in the face of each other, but that's what they're after. So let's talk about inflation. Inflation is being disrupted right now by energy prices. And so you can kind of hang off the headline drumbeat of what's going on with Iran. And that will then drive, that's the catalyst for oil price volatility. Again, the idea that we don't get any of our oil out of the Strait of Hormuz, well, it doesn't matter, because it's all a global supply. And when global supply gets tight, prices go up. So that volatility has really made inflation tough to pin down. And we do spend a lot of our disposable income on, fuel. To fuel our climates in our homes, our cars, things like that. I mean, it is impactful. So to say, well, we just strip it out to really kind of see what inflation is doing, that's tough because it's such a big piece of it. But what you can do, I think, is accept that this shouldn't necessarily last forever. The problems in the Middle East, I've been around a long time. I understand there are always problems around the world, but this is truly one of those shocks that we would like to see wound down. And then I think inflation would start to look good. So again, you're seeing some volatility in inflation. That volatility it bleeds into interest rates. But did you notice the bond market was positive this year? Or this month, excuse me. So the bond market being positive this month means that the bond vigilantes, or those out there in the bond world, that's all they do. They're kind of trusting that this could be just I don't want to say temporary, because it might be longer than temporary, but this isn't going to be a long-term impact, I think. So the inflation front, the fact that the bond market did pretty good, I think investors are willing to accept that we'll get through this, and then out the other end, maybe things look a little bit better. But I got to also say, the labor market remains strong, and actually our GDP is tracking pretty darn good. So again, you can explain that inflation piece, But what does the Fed do with it? How long are they willing to be patient? That's a question that I would like an answer to. So we'll be continually watching that situation.
Great.
Yeah, that was all great information. Bring it back specifically more to client accounts.
Yeah.
One thing we wanted to touch on was withdrawal rates.
Yeah. So we spend so much time in this podcast talking about the markets and stuff. It's a passion of mine. I love it. I mean, if you just give me a blank slate, that's where I'm going to go. But I get, that's not our sole purpose for clients. The financial advising side of things is really important. And, I think Carly and I were talking earlier about, okay, this is one negative month, but let's use it to unpack something that is important to clients. And that is, high withdrawal rates in negative market environments are really challenging, right? A really good market can mask a high withdrawal rate. It can make you feel like it's okay for the long haul. But remember what markets do. They'll give you seasons of oversized withdrawals, and then there'll be some times where very meager to negative. And so if we feel like we're really comfortable in those really good times, well, then what happens in those really challenging times? If you have too high of a withdrawal rate, those challenging times are tough. Here's why. Imagine if market's down, and let's just say June, because we decided that, it's the S&P 500 negative month. Your withdrawal comes out in that negative environment. It's harder to get back to even because theoretically we had to raise, enough cash for your withdrawal at a weak point. And so you would have less shares to bounce back. Now, a reasonable withdrawal, we fund that with dividends, interest, things like that. We're not really having to sell a whole lot. So you're able to ride back and ride through the volatility. But just, make sure that you're taking a prudent withdrawal rate. That's what's going to keep you flush over time, keep you safe over time. We like that because we care about our clients. Sometimes, maybe that's just not your plan. Sometimes life doesn't allow for that. We understand. We're not going to be the authority in that, but we do want people thinking about how much you're taking out, because that will be the key to whether your retirement is successful or not.
Right. And we're thinking overall, if you have a down month, we're not saying stop your monthly withdrawal.
Right. No, it's more a withdrawal rate, and you might say, well, what is a high withdrawal rate? Well, you could go and look at the 4% withdrawal rule out there if you do just a search on the internet. It's going to kick back the 4% rule. But remember, what the 4% rule is, you start at 4%, and then every single year you take a 3% increase to keep up with inflation. Well, the issue is that 3% on 3% on 3%, you get compounding and exponential growth on your withdrawal rate. I've been doing this for 20 years. 20 plus years. I don't have a client that calls me every year and says, I need my 3% withdrawal. I can tell you I don't. So a 3% inflation adjustment, I should say. So that's not really reality. That 4% rule isn't reality. Well, if you're not increasing your withdrawal every year, well, then you can kind of get to a higher starting point number. So context is really important to, your relationship with your money. So if you feel like you don't know whether your withdrawal rate is high, just give us a call because we can walk through your specific situation and give you some guidance.
Right. Yeah. Frequent withdrawals also don't help.
The one times.
The one times.
Those are tough.
Those are tough.
Yeah. So. And it's all part of one big kind of how much came out annually. In that year, how much came out, and that would kind of be your withdrawal rate. That's how we do the math. So but to Carly's point, maybe it was just an isolated incident. But again, just continue to talk to us about. Don't just put it on autopilot and never think about your withdrawal again. It's good to kind of have an understanding of whether you have a high withdrawal rate, low withdrawal rate, and we took the opportunity of a negative month to bring it up.
Yes. So looking ahead for July.
Okay, looking ahead for July, I think that the summer months might yield a little bit of volatility, and that's okay. That's actually healthy. The volatility is part of the ride. It's healthy. We need it. I think that we need to kind of get through some of that volatility to set up for a robust ending to the year. So be prepared for maybe July, August, maybe things firm up into September, but just be prepared for some volatility. We do have a backdrop that might lend itself to that. But I think that whatever we would experience from a volatility standpoint probably gives us a pretty good opportunity.
Right.
And I think that you'll probably see a little bit more rotation happening from those high growth stocks to, maybe something that looks a little bit more quality. I'm not saying that it's going to be some massive move, but that little tilt might be playing out. So, but hey, we'll unpack it all at the end of July.
Yep, sounds great.
Thank you. Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thanks for tuning in. We'll see you next month.